a big headline number of $1.5 billion of funding this quarter. I think the reality is, though, is that a big chunk of that was raised by a very small number of companies. The end of the golden burst of COVID and low interest rate fueled growth in venture kicked in at the end of 22. And so you can see the shapes of those curves show that even like last year was where it really slowed down. We're now marginally above where we were last year, which is great. The mood has definitely shifted, and it is moved to an environment where if you're a good founder with a business that's got solid fundamentals and you've survived the last 18 months, you're going to be in a good shape to be able to raise, is my view. I think the headline that a lot of people will pick up on this quarter is that AI has finally reared its head in the Australian market. And so we saw AI top the number of deals when things slowed down and everyone was a little less willing to invest and founders didn't want to potentially go out and raise. Venture debt was a great vehicle or a great mechanism to extend runway and allow companies to grow into their valuation before they actually had to hit up equity markets again. If you think about what companies were focused on this time last year, it was very much cost management. In some instances, it was rationalizing the team. And the shift that I've seen to say, okay, I think we're out of the woods now. The topics we're discussing are definitely shifting to growth. Not encouraging spam, but I am sending a very short email that says, hello, my name's Sarah. I run a business called X. It does this. We do X of revenue. We're growing at X. We're raising X. If those X's are impressive, then almost every Australian investor, if it fits their mandate, will respond. When we started reporting on cut-through venture, we did include equity crowdfunding. However, as I looked into the regulation and what the platforms were required to do in order to open up the platform to retail investors, I wasn't convinced that the regulation really ensured what it was potentially setting out to do. What we suggested were 7 things that we thought that they could do better, which were all aimed at doing good for the retail investor. And I think that they were pretty inoffensive, but happy to debate those. And I would love for the model to flourish. There are a lot of businesses that have raised capital on those platforms, and I want them to be successful. I just think that in order to protect retail investors that are doing this for the first time, I think they need to tighten up some of the ways that they operate.
Chris, so good to have you on. I really appreciate your time, given you're about to release this quarter's cut-through venture report.
No, great to be here, guys.
I thought maybe we could just kick off. Why do you create this report?
Why do I do it? Why do I put myself through the quarterly pain? So the backstory of Cut Through was I moved back to Australia almost 2 years ago, but the prior 10 years to that, I was in the US. The end of that was obviously COVID. I was working in venture capital on the corporate side for MasterCard. And my wife and I just had our first child, and there was a roadmap to come back to Australia. And so I did what any anally retentive person would do and started mapping the ecosystem of where I could find a job. And my conclusion as I went through reports by awesome organizations like PitchBook, Crunchbase, CB Insights, who really do a great job of covering the global venture ecosystem, was that either nothing was going on in Australia or very little, or they just weren't covering it very well. So I set out about trying to figure that out. And fortunately, pretty quickly, it became apparent that they just weren't covering all of the deals that were getting done. And you could see that just by reading the AFR, that PitchBook was not capturing all of that information. And Cut Through actually just started as a newsletter, and it was very self-serving in that I just wanted to know who was doing deals, what companies were getting funded, and I guess where the activity was from an investment standpoint. And by putting it in a newsletter, it was a good commitment mechanism to make sure I kept it up. Look, I didn't realize how big the pain point was in that very quickly it went from my 50 friends and family in the newsletter list. By month 3, we had 1,000 subscribers, many of whom were from all of the funds that we were covering. And then there were a couple of very lucky breaks where a couple of more high profile investors down here actually called out the newsletter in the press, and that sort of caused it to sort of skyrocket from a subscriber standpoint, and the press started using the data, and I started fielding requests from the AFR and various places. And that was the peak of the market. So it was very fortuitous. It would kick things off in 2021, where in any given week, there were 100 deals to report on. From there, moved back to Australia, continued on with the newsletter. And then it became apparent that it probably made sense to transition away from a monthly newsletter to a more formal document that we put out on a quarterly basis. Really wanted to mirror what the likes of PitchBook, Crunchbase, CB Insights do globally, so that we could really compare ourselves as an ecosystem. Also, as you guys know, venture is a very long-term game. And so reporting on stats, which is what we do, we don't try and dig too much into individual deals. We try and report on trends. Reporting on those trends on a monthly basis became a bit shaky in that people were picking up trends that weren't there on a month-by-month basis. So shifting to a quarterly basis made us align to the reporting schedules of what we were seeing other organizations doing around the world, but then also meant that we had more data to sink our teeth into and move closer to reporting on statistically significant data as opposed to data that would flip around on a monthly basis. So that's how we started. We now have 40,000 subscribers that download the reports. We put out a quarterly report 3 times a year, and then we do our big annual report, the State of Australian Startup Funding. And then we do ad hoc reports, most of which are for corporates that want to report on a certain segment of the market. But occasionally, and we're going to start doing some more deep dives on certain sectors that don't get a lot of airtime in our standard reports.
Oh, well done. It's a fantastic report and much needed. I remember taking different delegations to different international markets, and we'd always be asked for the comparable data. We'd sit in a presentation on, here's the investment landscape of Israel, here's what it's like in the UK, and we'd be asked for the counterpoint for the Australian market, and there was never anything reliable. So you've absolutely done an amazing job pulling this together.
No, I think the beautiful moment for me was when CB Insights, which I love, and the backstory for that business, if you don't know it, you should look into it. It's a really interesting business. They released a State of Global Venture 2 years ago, and Australia was not in it. So I think that proved the business case for what we're trying to do, which is really just trying to put the Australian ecosystem on the map. So we have pretty good data of where our readers are, and we have folks from VC funds and founders all over the world that read the report, particularly the annual report. So it's really great. And I run this as a side business, so I don't have to optimize for making as much money as possible from the report. So we can take creative liberty in terms of what we want to dig into and what we think is important and what will resonate with, and shine a light in a positive, and also shine a light on some of the challenges that we have as an ecosystem.
Just on that, I'm curious if you're comfortable sharing what the model is that sits behind this report to keep it sustainable, because we've seen things like, startup masters come and gone and come back again. I mean, we want this to exist. How do you keep it sustainable?
Yeah, so it's a sponsorship model. So we work with some really great corporate sponsors that support us with the reporting. We work with the big tech companies. As you guys would be aware, the 3 big cloud providers are really great supporters of the ecosystem, and we work with them in various ways. Big banks, law firms, all businesses that want to get in front of the investor and founder ecosystem are all great supporters. I used to work at MasterCard and in the venture team, but a big part of our team's extended remit was to partner with different organizations. And so I had a bit of a playbook on how to engage with these larger organizations. And so that's the model. We definitely never want to charge the readers for our reports. It would be counterintuitive to what we're trying to achieve, which is to get as many eyeballs on the ecosystem as possible. So yeah, by working with these sort of very deep-pocketed corporate partners is how we pull it together. And then we run a very lean ship. So my business partner and I, the only 2 people that are really dedicated to this locally. And then we have 2 folks overseas that are more data entry and do a lot of the first pass of the modeling. And then we rely heavily on agencies for the design work and making our janky looking slides look the way they do.
That's awesome. I'm curious, I'm keen to get into the latest report, but before that, coming back from overseas, doing this, what's been the biggest, most surprising thing or observation you've made of the Australian?
Yeah, it's definitely different. So I was in New York. I was also very focused on fintech and e-commerce, all the things that you'd imagine MasterCard, cybersecurity, all the things that MasterCard is thought and cared about. So I was sort of a subsector within the US market, but a very big one in New York. I think Australia as an investment community, I think I'm meeting you guys for the first time, but it's get to know the entire ecosystem or at least representatives from all the funds has been really easy. I think I have slight advantage in that I get to collaborate with the funds on the reports that we put out, but I've found that even when you're not working on a specific deal together, the willingness to engage and collaborate with each other on a personal level is quite high here. What I would counteract that with is that I think from a deal sharing and trust that when you're receiving a lead from another investor, I feel that the US, or at least in my experience, that investors are a little bit more open to it. We at 5V we're very specific. We invest at the Series A B2B software. And so the majority of the deals, just by definition, we can't invest in. And so we do try our best to farm out those opportunities that we think are high quality to other investors. But I do think that there is a little bit of a hesitation from a lot of investors in this ecosystem to take it as genuine, that you are actually trying to send them a good opportunity. That may just be my experience, but that's certainly one. So I think that just the nature, everyone's super friendly. I think far more easier to engage with on a personal level, but I think maybe might be partly because we're a younger ecosystem, but the engagement on actual putting rubber hitting the road on deals is probably not as high.
That bit's super interesting. We are similar, B2B, typically pre-Series A, Series A. We refer a lot of deals to others that don't fit, but I've never actually followed up to track stats on how many of them trust those referrals and go on to invest.
Yeah. I always go by the double opt-in referral. So obviously founders always want to get the intro to whoever makes sense. I think the denominator of being how many intros I make to how many acceptances, I think is probably lower here than what I would have seen in the US. But look, I think other elements, I think it is a very, honest ecosystem in terms of where we're at. I think we have high expectations of where it can get to. But I think when you talk to the folks that have been around for a lot longer than I have, when they tell stories of where we were 10 years ago to where we are today, it's super impressive on the growth trajectory. But I think there is an honest, those of us that are honest recognize that it is still very early days. It's a very small ecosystem. Our ability to back companies all the way through to be very large is probably limited. And so it's still very much the first innings, and having a few more success stories like Atlassian and hopefully Canva at some point at the end of this year or next will help put the ecosystem on the map.
Let's get into some parts of the report. So the report opens up with 5 things to know. It says the quarterly announced funding hit a 6-quarter high for Q2 2024, reaching $1.5 billion for the first time since 22. The surge was driven by the return of mega deals, with 6 startups raising $100+ million funding rounds. Total announced deals also bounced back, with 99 deals distributed across the full spectrum of funding stages. You then list out 5 things to know. What do you think the key bits are for people before they start reading the report around that?
So circling back on what you just mentioned, it was definitely pleasing to see a good bounce back in Q2. Q1 spooked everyone a little bit. It was pretty dreadful. And as you guys know, there's a lag in terms of when we get the data, but also when a deal starts to when it completes. And so we said last quarter that the real litmus test for this year would kick in Q2. So it was pleasing to see a big headline number of $1.5 billion of funding this quarter. I think the reality is that a big chunk of that was raised by a very small number of companies. There was a very large $300 million round in there, and then a handful of $100 million rounds. More than half of that 1.5 went to 6 companies. But I think one of the struggles one of the major slowdown globally for the last 18 months has been in those large deals. So it's the slowdown that we've seen at the pre-seed and the seed was not nearly as drastic as what we saw at that later stage. And so I think the return to seeing those larger deals is a great signal that those businesses that need a lot of capital to continue to grow and actually get to the next level now have those avenues open to them. In terms of the deal count, we counted 99 deals. I desperately searched for the 100. but couldn't find it. And what I would say, interestingly, it was unique from a quarter perspective where we saw a real spread of deals across the pre-seed, Series A, Series B, and then even a little later as well. So it wasn't that often when we have a big deal month, it's because there was a Startmate round announced and they account for sort of 12 deals or a Techstars round. And so it wasn't the case here. These were all true venture rounds and they were across the board. So it was really pleasing to see. I think the headline that a lot of people will pick up on this quarter is that AI has finally reared its head in the Australian market. And so we saw AI top the number of deals. And it's very hard to define what is an AI company. We tried our best to look at businesses that we genuinely thought that AI was at the core of their proposition, or particularly for some of those earlier companies that they truly wouldn't have existed if not for this new wave of technology that sort of hit us all over the last year and a half. So there were 12 or 16, one or the other, AI, pure play AI deals that we counted, and that put them on top of the ladder. I think it's probably not unexpected. We certainly at 5V see probably 1 out of 3 deals that hit the top of the funnel at the moment are AI or being positioned as AI. Whilst they undeniably closed a bunch of deals this quarter, I think the denominator of how many of these businesses are out there and trying to raise is higher than any other sector. And I tried to touch on that in a little thought piece that we put at the front of the report, which is just because you're an AI company, you shouldn't expect it to be an easy road. There are going to be far more AI companies that never raise than there are companies that go on to raise millions of dollars.
But to be an AI company, you just need .ai.
Well, yeah, the snarky side of me called our thought piece .ai does not mean .funding, which, yeah, we run a really basic, using the OpenAI API, run a really basic script over all of the websites that announced, and we count how many of them mention AI on their cover page. And it was in the mid-30s this month, which was up on last month. But yeah, you can bet that most startups have acquired the .ai domain name. We don't have it at 5V yet. We actually do own it for cut through, but we don't have a AI application yet.
I do like that little piece at the start though. And it was interesting picking up the investor sentiment and a couple of stats in there, like how many AI first startups has your firm invested in 24? 57% none. And it looks like 50% are neutral or not interested in an AI led or AI first startup. And that's a nice breakdown, actually. I was a bit surprised. I thought
it makes us feel better because we
were
haven't
the only
invested
ones
in one.
Look, it scares the hell out of me. I'm so glad that we invest at the Series A, because trying to invest in a pre-seed or seed Australian AI company at the moment, or any AI company at the moment, would scare the hell out of me. I had a nightmare the other night that I'd just invested in one and woke up to OpenAI announcing a feature that just killed the company. So like I truly had that nightmare. So yeah, look, it's good that they're getting funded. There were a couple of pre-seed stage companies that weren't around 2 years ago that got a couple of $1 million in the door to start building. And I think that would love to get your perspectives on this, but my observation is that Australian founders are quite pragmatic and do look for problems to solve. And so the businesses that we're seeing are grounded in some business problem and trying to apply AI to help solve that problem better. Whether or not that's truly an AI company or it's just a business that's using the modern tech stack available to every startup is another question. But yeah, it's certainly the hot sector globally, and Australia, it's showing in the numbers for the first time.
The next slide was total capital raised. For the listeners at home, this is a visual chart that just shows each month of the year comparing 2020, 21, 22, 23, 24. And 24 is bang in between sort of the middle of the road where we were before COVID to during COVID. Would that be a fair summary?
Yeah, so I think the end of the golden burst of COVID and low interest rate fueled growth in venture kicked in at the end of 22. And so you can see the shapes of those curves show that even like last year was where it really slowed down. We're now marginally above where we were last year, which is great. Again, largely driven by a couple of big wins early. And so that will undoubtedly or potentially shift back and forth over that line. But the important thing is that when you look at our sentiment survey in terms of asking investors how they feel about the market and how they feel their firm's going to behave for the remainder of the year, there's been a clear shift. This time last year, investors were very cautious. They were focusing on number one priority was look after the portfolio. That has now shifted to making new investments, and raising funds is a big priority. But the sentiment within investors has shifted. It looks like, at least from our perspective, our portfolio is in great shape. I know speaking to investors now versus this time last year where everyone was talking about fires in the portfolio, that is certainly, there will forever be little spot fires in the portfolio, but the general trend of the entire house being on fire has slowed. And so I think we're in a growth posture, I would say, as an investor base. I don't make predictions because I'll always get them wrong, but my sense is that we're in a good position to continue to have that curve go in that growth curve of the funding line go in the right direction for the remainder of the year. And we should finish up with a second half that looks more like Q2 than Q1.
And Chris, are the insights consistent with what you've been seeing on a micro level at 5V?
Yeah, so we are, I guess everyone thinks they're unique, but I'll tell you why we're unique. We're a $70 million fund that will only invest in around 15 companies. So we write a pretty large first check into Series A, but we only do 4 or 5 investments a year. We take a board seat on all of the companies that we invest in, and we're very hands-on without really a programmatic approach to serving our portfolio companies. We get in there and do what's needed based on the needs of the business, and we stay out of the way if they don't want our help. But I raise that because we don't have a huge data set. I don't have a huge data set to look at, but I think that if you think about what companies were focused on this time last year, it was very much cost management. In some instances, it was rationalizing the team, and certainly we're not in a position of where the main focus at a board meeting was growth. It was around costs and ensuring that they are extending their runway. The shift that I've seen over the last couple of board meetings, and most of our board meetings as a hangover of that era, we are still meeting it on a monthly basis, which is a more regular cadence than what you'd probably meet as a startup board, but a lot of our companies still are. And I think a lot of them are starting to shift to say, okay, I think we're out of the woods now. We can go back to the quarterly board meeting, but the topics we're discussing are definitely shifting to growth. So whether it's new markets, new key hires, all the things that have been a little bit on the nose to talk about or no one's been game to over the last 18 months has certainly returned, which is super positive. So we don't have a huge data set, but I would say that overwhelmingly within the portfolio, things are going well. Could always be better. I don't think anyone's looking forward to their next fundraising, but then quarters like we just had is certainly a encouraging sign for businesses, particularly if they need to raise big rounds in the next few months.
Yeah, I totally agree. I mean, that's consistent with what we're seeing as well.
Hey, Chris, the other part of the report that I'm always interested in is the investor insights, their view on deal volume, deal quality, and then also their kind of interest areas. And I'm always trying to forever interpret meaning into it, which I should probably give up on. It does look like my broad read is more deals coming through in terms of VCs and investors looking at them, but also portfolio health seems to be improving and more of them coming back out to market to raise capital as well.
Yeah, within our portfolio, we've got a bunch of companies that have been in the position of readying to raise that are now like going out to market. There was an article in this morning's paper about Grow, which is a phenomenal business that's modernizing the superannuation industry, and they're a portfolio company, and they just announced a big plan for a $60 million raise. So there are definitely, and I would say all through the portfolio, I would say 50% of the portfolio will raise in the next 12 months. I think previously the view would be, the stated goal would be that we didn't want anyone going out raising necessarily if they didn't need to. And so we think that the capital markets are open, particularly for businesses that are not having to raise upward of $20 million. I think Grow is an exception. It is a very good performing business, but they will be looking well beyond 5V and potentially beyond the other current investors for investment. And they've been nurturing those relationships for the last 12 months, and we're confident they'll get away. We're of the view that it's really important for companies that have a presence or plan to have a presence overseas to look overseas for investors. So I know you guys spend a lot of time taking portfolio companies around the world. We don't quite do that, but we do prioritize making sure that we have a good network of investors in the US and the UK and Singapore and Hong Kong that we can get our portfolio in front of. And those markets are firing. I just came back from the US on a family holiday, and New York was like truly on fire, not in a bad way. I'd heard it was in a bad way, but it was in really great shape. And the conversation I had with old colleagues and people that I'd worked with in the venture space said they've never been busier. It is really AI focused, but they're really deploying capital at a pretty rapid clip and seeing some really interesting new businesses come to market. So I think the mood is, as I said before, the mood has definitely shifted, and it is moved to an environment where if you're a good founder with a business that's got solid fundamentals and you've survived the last 18 months, you're going to be in a good shape to be able to raise, is my view.
Yeah, super interesting. So very much aligned on your vision and that international aspect with your portfolio. And interesting to hear about the US, because we just got back from the UK, and I describe it there as like not on fire, but definitely more buoyant than other markets. And it held pretty well through the last 3 years. I think the stat I remember was £21 billion invested in the last year in the UK ecosystem, and quite healthy and closing the gap on US data points. So they're definitely staying up there, and the sentiment seems to be it's going to pick up again very quickly. So, mate, I have a question that this has always been intriguing to me. The sector shifts in popularity.
Yeah.
It is a very pretty chart, and I look at it often, and I always try and interpret some sort of meaning out of it. But any key insight in there for you? Are there insights you draw from that or extrapolate from it?
Look, I think the genesis of it was to try and figure out whether or not investors actually did what they said they would do. And so a proxy for said they would do is what they're most interested in. And then to test that, does it line up to where the dollars are flowing? It largely does. So as you guys know, Australia is all about B2B software. There's very few investors down here that don't want to invest in B2B software, and B2B software is forever towards the top of that popularity list. There have been other sectors that were very hot or medium hot and have just been down in the doldrums. So like crypto would be the most obvious, despite the sort of resurgence of Bitcoin. I think that crypto as an investable category from a venture standpoint is still very hard to wrap your head around. And I don't know that I won't name names, but there are some investors locally that really do understand it and have spent the time. But for the majority of us, it's not a space that we've really ever spent the time to get comfortable with. And so that sort of sits in the doldrums. There are areas which I personally have never invested in that you could argue have not traditionally been venture backable businesses, but have gone on to produce some really great returns. So more like food and beverage type companies, and not food science type businesses, but actual brands, alcoholic beers and toilet paper businesses that have all proven me wrong and have done really well. But those sectors that really ran hot during the boom era of venture, or the most recent one, have come off a lot. It was interesting to see like how quickly AI shot to the top of those popularity rankings. But I guess there was a big trailing period before it actually started to show up in the actual funding data. So I think that is an interesting one, in that you say, okay, investors need to get excited about something a little while ahead of when they actually start to deploy capital. They've got to get confidence, get up to speed, go find the businesses, and then there's a lead time to actually closing a deal. It is interesting. I think it's you guys mentioned on the podcast last week, invested in a business that you could say is in prop tech. That's certainly their first market and one breadcrumb. An area like tech has become super popular amongst investors, but very small dollar amounts, relatively speaking, going into the space. It's an interesting one. It's not intended to be super analytical, but more, the genesis of it was a little bit cheeky to test whether or not we are all honest with ourselves or not. And I think it's a mixed result.
Because I would often try and correlate that data to the actual investor and go back to past reports of where sentiment was shifting.
Yeah.
But just thinking about that, I'd imagine you would get some interesting insights on an investor level, I imagine. Like you would be seeing activity, potentially returns and gains being read into the data. Will there be a shift towards reporting on those sorts of things in the future as complicated and as much of a minefield as that might be?
Yeah, so I think in our first ever annual report that we did, so the State of Australian Startup Funding in that big boom year, we did report on the activity levels of individual funds. I think the only time I've received hate mail on the new report was from that. And the morning that we released the report, I was still living in New York. And so it was late evening in the US and we released the report. And I just got bombarded by investors saying, oh, you said I did 12 deals, I did 14 deals. And so for the value that it provided everyone, I don't know that it was worth the trouble, in that we know that we're not getting every deal. We fully acknowledge, and we've never claimed that we capture every deal that gets done for a multitude of reasons, as you guys know, and I suspect most of your listeners know as well. Like, often these private deals don't get covered, or they get covered really late. And we have a whole bunch of different places where we can source deal information for deals that haven't been announced, but they're very low on detail. And often, particularly on the investor side, to the point of your question, not all the investors are listed out. And reporting on individual investor activity is a challenging one, just because we'd prefer to not do it than just be wrong. And at the same time, we don't want to upset folks unintentionally. If they do something wrong, we don't mind upsetting them. But if we underreport them just by virtue of them being a more private fund, we want to avoid that. We do try and give as much of a podium to investors in the ecosystem that we think have something valuable to say, and always ask for feedback or ideas what to include in the report, and then also offer up the opportunity to provide quotes every now and then as well. Yeah, the league table bit is the precarious zone that we have flirted with, but it didn't end that well last time, so I'm still a bit damaged. But maybe you guys could do that. Okay.
No, we're quite happy not to get the hate mail. Yeah.
Yeah.
No, but well done. Yeah, and I totally understand not taking that on. You look at a lot of these, PitchBook and others, and increasing now the number of tools that are available to signal or find potential deal flow for investors. Would you ever go down that path with the data that you have and the companies that you have visibility on, providing that sort of service?
So it is a completely different ballgame to try and open up the data in that way. I think we've had a number of approaches from businesses that have a platform that surface data about companies and would like to incorporate our data into their platform, and so just have it as a data point that could be potentially paid for as an extra data point. We're definitely open to those types of arrangements, and there are a number of conversations ongoing on that front. I think building out a platform, trying to be the Crunchbase of Australia, is probably not the play. I think candidly also, early days of when we first were releasing the newsletter, we broke down actually in pretty granular detail every deal that happened. Within a day, all of those deals were on Crunchbase. And so there's a little bit of an IP issue that we haven't quite figured out how to handle unless you go really large. So having a very sort of janky MVP version of Crunchbase that just shows our data, I think we'd pretty quickly not have a unique data set. And for us, I think like our focus is not necessarily but certainly not to allow investors to source deals. What we're trying to do is to shine a light on the ecosystem, show from an insights perspective for investors and for founders what the trends are in terms of how much money is being raised at different rounds, what sectors are hot, and some of the other trends that we think are important to cover. But yeah, I think we know our role, and I certainly have no interest in quitting the day job and going out and trying to raise tens of millions of dollars to try and compete with PitchBook and Crunchbase.
Yeah, I totally can understand that, Chris. We have a lot of founders that listen to the podcast. Are there any just general advice and tips on the current state of the funding market? And then any insights that you want to particularly talk about that resonate to founders?
Yeah, look, I think that you asked a question up front around what the differences between the Australian and the US market are. I think one of the really positive things about this market, or my observation, is that most investors are very keen to get deal flow. So there are very few investors in this market that require a warm introduction. There are very few investors that have big hoops to jump through to apply for capital or investment. So I think you should definitely, as a founder, take advantage of that fact that majority of the funds here, even the original OGs of Australian venture, they're still all very keen to get deal flow. And so it's also very easy to find out who we all are. And so not encouraging spam, but I am sending a very short email that says, hello, my name's Sarah. I run a business called X. It does this. We do X of revenue. We're growing at X. We're raising X. If those X's are impressive, then almost every Australian investor, if it fits their mandate, will respond. And so I think it's a little bit of we launched a platform called One Pitch that allows founders to submit their one pitch and it goes out to a long list of investors. But in reality, it's not actually that hard to find the investors and just get in front of them. Now, not every company will get venture funding, but if you're hitting the right metrics that an investor wants to see, you should be able to say that in a very succinct email and get it in front of them. And 9 out of 10 Australian investors are still hungry enough to be responsive. Not to say they'll say yes, but they'll be very open to engaging, I suspect. Now, everyone's different, but I do think it's a pretty open ecosystem. And as I said, people are hungry. No one's declared victory as a super successful venture fund yet. Some of the early funds are certainly making a case for it, but we're all very early in our respective journeys. And so I think we're all looking for the next great deal. And so don't be afraid to reach out to as many investors as possible.
That's a good reflection. In the UK, you almost need the warm intro to be heard. It's feedback from the market. So that's a really good point. I'm curious, you said something at the start too, with that international comparison. One of the things that got talked about here, probably more so 18 months, 2 years ago, was just the number of new VC firms in particular that had launched in the Australian market and the kind of jump in funds under like dry powder. And there was a bit of commentary about does the Australian market have enough startups to invest in, which my perspective was comical. But with your international experience, keen to hear your thoughts before I bias them with mine.
I don't know the answer. There's definitely enough talent. If we siphon some of the people that were still... So I started in banking and traditional finance, and my family is a whole bunch of ex-bankers and lawyers, and my wife's a lawyer. So if we could siphon some of the talent away out of those traditional industries and make it really cool and sexy to start your career in tech, and then 5 years later, a bunch of those people left Google or Facebook or wherever they started, Canva, and they went off and started businesses, I think absolutely we would have enough companies. So there's no shortage of young people that could be starting companies. I think as it stands today, there are certainly more companies out there trying to raise capital than there is capital that is being deployed to them. I think I would say my observation is that a lot of startups that we see that are too early for us are probably there's question marks over whether or not the ambition for the business in terms of how big they want to build it is big enough to actually be venture backable. So I think there are some really amazing little tech-focused businesses that can provide a really great lifestyle for the founders and potentially a decent-sized team. But a lot of the companies, if I contrast it to the businesses that I'd come across in the US, a lot of the earlier stage software businesses are still, I don't want to say small-minded because they're not, but it's probably having an expectation of how big they can grow their business. So the question of are there enough startups? I think that there probably are. It's around whether or not those startups have the ambition to grow very large businesses, which then make them venture backable. I don't think that there are too many funds. I think that there were absolutely a number of smaller funds that raised for the first time during 2020, 2021, that are having to go around again now to raise their second fund. And just like any startup that's tried to operate over the last 2 years, in many instances, it's hard for them, not because they're necessarily bad. They're certainly not, in almost all cases, bad investors. It's just that the state of the portfolio, by virtue of what's happened from a macro perspective, is not the type of portfolio that you want to go and showcase to potential LPs. Now, if you were allowed another 2 years for it to bake, then it could be a very different story. But the reality is, if you've invested your full fund, you've got to go out again and raise again. And timing is everything, unfortunately. But I don't think we've got too many investors chasing after too few opportunities. I think there's plenty out there, and it's just about the size of the ambition of some of the businesses, because we haven't had that many examples of huge outcomes in this ecosystem to act as the poster child for ambitious founders.
Yep.
One of the things we're seeing in the ecosystem, and it's supported by your report, a lot more interest is going into venture debt. Do you think that's because there's just more facilities available, or are more companies growing to a point where actually they are better suited for venture debt and there's dragging debt out of the hands of investors?
Yeah, look, I think it's a combination of the both. There certainly are more vehicles or firms that are investing at all stages and have different constructs for the different use cases than there were even a couple of years ago. Very early stage working capital type facilities. And that is a very competitive space, and the rates are not cheap, but they can be very useful if used correctly. And then you have sort of stalwarts of the space like One Ventures, and then a number of the investment bank type firms that are providing much larger loans that are at very competitive rates and can be used as an alternative, frankly, to venture capital. I think also that over the last couple of years, when things slowed down and everyone was a little less willing to invest and founders didn't want to potentially go out and do a down round, venture debt was a great vehicle or a great mechanism to extend runway and allow companies to grow into their valuation before they actually had to hit up equity markets again. And I think by virtue of doing that and having some good experiences, VC investors have grown more comfortable with it as a sidecar funding solution to their own capital. So look, it's a very mature space in all of the major markets around the world. And I think even in the short amount of time that I've been back in Australia, the way in which VCs think about it and how it can be used and how it could or should be used in the portfolio has definitely evolved, would be my observation. At 5V, we've always been very open to it if it makes sense. I think part of that is we are part of a private equity firm, and so we have some folks in-house that really understand it well. But we've always been supportive in the right circumstances where it can be used in a way that actually fuels growth. But yeah, I think the rest of the ecosystem, or large share of them, are coming around to that as well.
There's been quite a burst of new companies getting into venture debt, almost taking it from like a fintech kind of approach. And some of the companies I see taking on debt, I fear may not realize the problem with debt is you've got to pay it back. I think we may next year maybe start to see a bit of loss occurring in there, but I may be overly pessimistic. I'm not sure what you're seeing on the ground.
Yeah, so I think by the time we get involved with a business, they're doing a few $1 million of revenue and have a proper finance function most of the time, or a senior financial controller in place that has a reasonable grasp of finances. We would absolutely never be supportive of debt being as a sort of funding source of last resort. That doesn't bode well for anyone on the cap table, including ourselves. I do think that there is, just like in any lending industry, there are good actors and bad actors. There are a lot of people within venture debt in Australia that have come from venture capital or have come from running a startup themselves and have built products to try and solve the pain point that they identified in either of those roles, or the gap is probably a better way to describe it, that they saw in those roles. There are certainly predatory type actors, just like there are in the mortgage industry and the car loan business and everywhere else. But like any investor that's on the cap table, particularly if you're a board member or a more hands-on investor, will have a perspective that hopefully part of our responsibility as a VC and an active investor is to help guide the portfolio companies and the founders to make right decisions as it relates to bringing on debt. But yeah, absolutely, there will be bad actors that take advantage of that potentially doesn't know what they're doing or is in lender of last resort mode, for sure.
Just shifting gears a little bit, I think it was a couple of months ago on our weekly news episode, we did an article by Bronwyn Clune from Capital Brief, just talking about equity crowdfunding. And one of the people featured in the article was yourself. Equity crowdfunding used to be in this report. You then took it out. And in that article, you raised some areas of concern. Without going too deep into it, would just be good to understand your perspectives.
Yeah, absolutely. So just to be clear, the only time I've commented on equity crowdfunding was in our most recent State of Australian Startup funding report. So I know Bronwyn, I think she's a great journalist, but when she reached out to me, I just pointed her to that report. And so everything in that article, which I stand by 100%, was quoted from the one page in the State of Australian Startup Funding, which sort of, what we did was try to outline, was not just to shit can equity crowdfunding, to be clear, on a first principles basis, I believe I'm incredibly supportive of any mechanism that opens up this asset class to retail investors, but it needs to happen in a safe way. And yes, when we started reporting on Cut Through Venture, we did include equity crowdfunding. However, as I looked into the regulation and what the platforms were required to do in order to open up the platform to retail investors, I wasn't convinced that the regulation really ensured what it was potentially setting out to do. We weren't super critical or prescriptive in terms of what they were doing wrong. What we suggested were 7 things that we thought that they could do better, which were all aimed at doing good for the retail investor. And I think that they were pretty inoffensive, but happy to debate those. So the first one was to have simple financial metrics front and center at the front of the investment paper and on the deal page. So if you ever go onto these platforms, some of them do a really good job of this, but others don't. In a similar vein, number 2, have very clear value metrics on the deal. So whatever the right valuation metric is for that type of business, if it is a technology business, then a revenue multiple. If it's a brewery, an EBITDA multiple, or whatever the right metric should be, but just to have very clear value and metrics listed. I do think that a requirement to list out previous attempts to raise capital in other means is important. So any VC investor would be privy to that, because as part of our investment process, we would go into a data room, and in that data room, it would have a whole bunch of information, and it would have prior board papers, and you would have insight into the processes that have been run in the past. And if you didn't, you could ask for it and they'd have to tell you. So I do think that on the basis that not all, but quite a few companies that list on those platforms have done the rounds of trying to raise venture capital before. I'm not saying that the venture capitalists are right, and by virtue of them saying no, that these are bad businesses, but I do think that it is a disclosure that's worthwhile. The next 2 are pretty simple, like celebrity endorsements on a financial product, I think it just doesn't bode well with me. I don't understand why you would have a celebrity endorsement on a deal. You can celebrity endorse the product, but to make a financial decision to invest in a company, I don't think it makes sense. Similar with social media, like it's shocking to me how much some of these platforms promote deals across social media and LinkedIn. It's fine to do it, but they should follow the same sets of rules and regulations that other financial services do. And then I think the other 2 are really centered around the platforms themselves. I think there is when you guys go out and raise a fund, or when we raise a fund, we have to disclose our prior performance to LPs. And so I think some transparency in terms of how the deals on the platform have performed in the past is something that is not a low bar. You don't have to give granular information, but to provide an update on how the deals have performed for new investors coming in and investing for the first time. And then I think the last one, which is a tricky one, because I understand the business model makes it challenging, but the majority of these businesses, the platforms, make money fee for service. So they'll take a percentage of the total funds raised. And I think it's completely reasonable. Everyone needs to have a fee structure. But what that doesn't necessarily do is have them have skin in the game in terms of ensuring that the quality of the companies that they're putting forward are businesses that they themselves would invest in. As an investor in a fund, there's a requirement called a GP commit, where we invest our own money into the funds that we invest then on behalf of our LPs. And I think that having some sort of mechanism that aligns the interests of the platforms to ensure that there is some level of ensuring that these are businesses that they've either diligenced themselves or put through some level of scrutiny before they list them. And I'm sure they do that, because it would be terrible for their brand to just list a whole bunch of garbage. But just having a way of actually showing that is all I'm asking. So again, look, if any of those are silly, then I'm happy to chat through them further. But that's really the extent of my view on it. And I would love for the model to flourish. There are a lot of businesses that have raised capital on those platforms, and I want them to be successful. I just think that in order to protect retail investors that are doing this for the first time, I think that they need to tighten up some of the ways that they operate.
We had Matt Vitale, CEO of Birchall on. It was just pointed out back in May and highlighted the competence of the production department within Tribe Global Ventures content. So that will be coming out soon. But one of the things that we did ask was around previous attempts to raise capital. And one of the questions that came up is, what would we define as an attempt? Is it as in gone into that DD and then the VC who's run its eyes through it has said, nope? Or is it the submission of a pitch deck?
It's very subjective. And I get that. I don't think it's an unsolvable problem though. So just finding a way to provide more disclosure. Quite often the positioning of these platforms is you investing in startups or venture capital. This is an alternative to venture capital. And it's just, if you're using it from a marketing perspective to present the business, then you should also have to disclose the history of how they ended up there. But I acknowledge that it is subjective, and trying to figure out exactly a way to do that is standardized would be tricky, but I don't think insurmountable if some people smarter than us four put their heads together.
I totally agree, Chris. And I actually think retail investors aren't actually aware that there is a high probability that company has already spoken to professional investors and now have come down a different pathway seeking funding. So I don't think it has to be overcomplicated, even if it's just a disclosure and then it's just making the retail investor aware. Like, I don't think we need to overcomplicate this, and it easily could be done. These were 7 points to help try and protect the retail investor, but I actually think it's 7 points to protect the model of crowdfunding for long-term success. If you're here for the long term and this is going to be an avenue which we believe should mature, then those points only benefit the model.
No, and I said that, look, it's been a while since I looked at the piece, but there is a mention in there that we think that this will strengthen the platforms. Now, there may be certain businesses that can't raise on the platforms anymore, but the caliber of the businesses that do will be much higher, and that will in turn bring in more high quality businesses. And there will be people like myself, and there are many others, being the only one quoted in the article, that feel that this is a slightly flawed model. If there were some of the changes that could be implemented, then I suspect there'd be other people that would get on board as well. I know they're not trying to placate Chris Gillings, but I do think that if you're playing in the ecosystem of venture, then running the business in a way that sort of gets bought into by not just a minority group within the venture ecosystem is important for your success. So I think, Jack, you're completely right.
Especially around valuation, it is one of the things, and I'd support some kind of, even if it was a broad series of metrics. I've got 3 of my portfolio, my personal angel portfolio, that have recently raised on crowdfunding. And if everything goes really well, as we know with Canva or anything else, valuation at this early stage isn't as important as performance. To get an actual ROI that's acceptable over 5 or 10 years, entry price does play a factor.
I've invested in these platforms in the US. There is a model by which it works. I think, as I said, I want these platforms to do well. I want more people to be able to invest in all businesses, startups, fish and chip shops. Like, if they are passionate about it, or if it's a family member or a friend, or if it's an area they know really well, then I don't think having some minimum threshold of how much money you earn should drive that. However, I do believe that it is a risky business of investing in early stage companies, and there should be protective measures. The funding stats in our report. So the business is called Cut Through Venture. I would say 50% of the companies on those platforms are not startups. They're sort of small businesses, breweries, really cool businesses, and businesses as an angel investor you'll be interested in investing in. But we have to draw a line in terms of what gets covered in the reports. And we are investing in this traditional understanding of what a startup is. And so that's the first challenge, of trying to piece through or make a call on which of the companies on their platforms are like what you would call a true startup. The second piece is that the data is not easy to get. So they're not super transparent. And I talk broadly, and I'm intentionally not mentioning any platforms by name, but some of the platforms do a really good job in terms of sharing the data. Others don't. And so for us, we're a small team. If the data is hard to come by and they don't want to share it, which we did ask for the reporting just in a spreadsheet, and some were willing to share and some were others. So it wasn't made super easy for us to report on it. And then, yeah, I think that there are, like, I do fundamentally believe there's a place for them in the ecosystem, but on the basis that there are some ways of running the operation that I don't think is good for investors or for founders, or it's my call to make, I guess. But look, if they made it easy to do it, that would be a good start. And I don't think the suggestions we've made are super overbearing.
So Chris, I guess in terms of the future of Cut-Through Ventures, anything on the roadmap for new additions or changes to the report at all?
So we are definitely going to be coming out with some deeper dives into certain sectors. We are forever critiqued on not doing a great job of covering certain areas. And honestly, it's probably true, and it's probably because I don't understand them too well. Some of the sectors that are a little bit more deep tech focused or med tech, expect to see some smaller reports that we put out with some partners around that. But otherwise, we're just going to continue what we are trying to do well and stay focused on funding. You won't see us start delving into other data sets. We're a small team and want to just focus on doing as good a job as we can on covering the venture ecosystem. But we recognize that we could go deeper on certain areas that have probably been skimmed over a little bit in the past. So watch that space. And then the rest of it is we do events and sort of other ways to get in front of founders and get in front of angel investors. So lots of interesting educational type events. We've moved away from happy hours and community type events where we try and do as thoughtful as we can, educational focus. So panel discussions or deep dives with different founders that have been successful. So we do those in partnership with other companies. And so those are all local, either local market, and occasionally we do some online stuff, but we try and keep them small. And we generally reach out to founders direct or folks that are already subscribers to what we do. We mine the database to see who could be a fit. If you are a founder, the best way for us to find you is to just subscribe to the newsletter.
Well, Chris, it's been an absolute pleasure having you on. I just want to say the Cut-Through Ventures report is absolutely needed in our ecosystem. You're doing such important work and really high quality content in the reporting as well. And I know it must at times be painful with all sorts of egos and others wanting to weigh in and have their say and how data is presented or otherwise. Well done navigating all of that. And for your sponsors and partners and those that also help make this happen, I just want to reiterate how bloody important this is. I alluded at the start, I actually use your report when presenting to different international delegations that come into Australia and also when we're overseas in different markets. And it's just so valuable to have. So really appreciate everything you do to make that happen.
You're very kind. No, I appreciate it. And look, it's fun. I get to meet with people like yourselves and other interesting people that I wouldn't have otherwise got to if I'd just shown up here after being out of the country for 10 years. Really appreciate it. I guess the call out here is if you're a Series A startup looking for funding, that's C Gillings at 5vcapital.com. And then, subscribe to on cutthrough.com to get updates on all of our reports and events if you're a founder or an angel investor.
Yeah, we'll be sure to include those in the show notes as well, so those links are handy. But thanks again, Chris. Really appreciate it.
No, it's great to see you guys.
Cheers.
See you soon.